Debt explodes, America on the brink.
Markets shake, credit rating at risk.
Government shutdown triggers financial alarms.
America's credit crisis just turned real.
The U.S. isn't just shutting down, it's tearing a hole in its own credit score. Every lost week rips billions from GDP. Every delay pushes America closer to a downgrade that could explode borrowing costs overnight. We've seen this before, $11 billion lost in 2019. But this time, the debt is bigger, the rates are higher, and the world's patience is thinner. The question isn't if America can afford this shutdown, it's whether the shutdown will afford to keep America standing at all. Let's strip away the noise. What does a US government shutdown actually mean? It means hundreds of thousands of federal employees are sent home without pay. It means government services freeze. It means investors, businesses, and global markets get a front-row view of America's inability to govern itself. And here's the number that should make you sit up straight. According to the Congressional Budget Office, the 2018-2019 shutdown, the longest in U.S. history, cost the economy about $11 billion. Of that, at least $3 billion was gone forever. That money never came back. Now, imagine the scenario in 2025. Debt is not $22 trillion like back then. It's past $34 trillion today. Interest rates are not near zero anymore. They're the highest in over 20 years. That means the US is already paying nearly $1 trillion a year just in interest. A shutdown now doesn't just shave GDP growth. It rattles the very foundation of how America borrows money. Think about your own credit card. If the bank thinks you can't pay your bills, what happens? Your interest rates shoot up, your borrowing limit shrinks. Now, scale that up to the United States of America. America's credit rating is essentially its global trust score. It tells investors, countries, and markets, yes, you can lend money to the US. It's safe, reliable, and will pay you back. But if that score slips, in August 2011, Standard & Poor's downgraded the U.S. credit rating for the first time in history. The reason? Political dysfunction over, you guessed it, the debt ceiling. The fallout triggered a stock market sell-off and shook global confidence. And here's the terrifying part. Another downgrade is no longer a theory. Fitch already downgraded U.S. credit in 2023, citing erosion of governance. Moody's has warned it could follow. If shutdown chaos drags on, credit agencies could strike again with consequences ordinary Americans will feel in their mortgages, their car loans, their credit cards. Let's rewind. In 1995-96, shutdowns under President Clinton cost the government over $1.4 billion in today's dollars. In 2013, the shutdown over Obamacare cost the economy about $24 billion, shaving 0.6% off quarterly GDP. In 2018-19, as we said, the 35-day shutdown bled $11 billion. Each time, the numbers stack up. Each time, America plays chicken with itself. But this time, the stakes are radically higher. Debt has ballooned. Rates are climbing. Global rivals are watching. Back in 2013, U.S. debt was about $17 trillion. In 2019, it was $22 trillion. Today, as we speak, it's pushing past $34 trillion. And here's the kicker. Interest payments alone are expected to become the largest line item in the federal budget within the next decade, bigger than defense, bigger than Social Security.
When Washington shuts down, it's not just a pause in government. It's a signal to the world America is willing to risk everything, even its reputation as the safest borrower on earth. Let's talk cold, hard growth numbers. Economists estimate that every week of shutdown reduces U.S. GDP growth by 0.1 to 0.2 percentage points. That might sound small until you stretch it. 4 weeks, nearly a full percentage point off annual growth. That's billions of dollars vanishing into thin air. And here's where it gets worse. Those aren't just numbers on paper. That lost growth is canceled contracts, frozen paychecks, missed mortgage payments, small businesses unable to secure loans because federal approvals are delayed. Here's the brutal truth. Shutdowns don't happen because America runs out of money. They happen because politicians refuse to agree on how to spend it. One side demands cuts, the other defends programs. The fight drags on. The government grinds to a halt, and ordinary Americans become collateral damage. Representative Salud Carbajal once warned that shutdowns weaken our economy, hurt families, and jeopardize national security. Yet here we are again, staring into the same abyss. But here's what most headlines miss. A shutdown doesn't just impact federal workers, it ripples outward. Contractors lose billions, small businesses near military bases or federal offices lose customers. Air travel slows because TSA agents aren't paid. Scientific research halts because labs are shuttered. Even food inspections, critical to public health, are delayed.
Every shutdown is a silent chain reaction. Every week it continues, the ripples widen. And this time, those ripples could collide with America's already fragile credit standing. So, here we are, debt soaring past $34 trillion, borrowing costs already squeezing the budget, credit agencies sharpening their knives. The stage is set. The question is not whether shutdowns are painful. We know they are. The real question is this: how close are we to a tipping point where America's shutdown politics finally break the system? Because now, we'll explore the deeper layers. What happens if the shutdown drags on, how global markets react, and whether America's credit collapse could trigger a financial shockwave felt in every household. Let's pick up where we left off. Debt soaring, borrowing costs rising, credit agencies circling. The question isn't whether shutdowns hurt, it's whether one could finally trigger a collapse. Imagine this shutdown doesn't last days. Imagine it stretches into weeks, then months. Every passing week, GDP shrinks by 0.1 to 0.2 percentage points. By month's end, America's growth has taken a full percentage point hit. That's tens of billions wiped away. Now, combine that with the fact that the US already spends nearly $1 trillion annually on interest payments, more than the defense budget of any country in the world. Add the lost tax revenues from idle workers and shuttered services, and suddenly the federal deficit balloons even faster. The irony? A shutdown meant to force fiscal discipline ends up costing America even more.
Remember the downgrade of 2011. Remember the Fitch downgrade of 2023. Credit agencies are not patient teachers, they're ruthless judges. If Washington cannot demonstrate the ability to govern, agencies can, and will, cut America's rating again. What happens then? Borrowing costs explode. Every treasury bond sold carries a higher interest rate. That higher rate trickles down into the economy. Mortgages become more expensive, car loans spike, credit card APRs climb. For ordinary Americans, the downgrade isn't abstract. It's a bill that arrives every month. Here's the part that should keep you awake at night. America's treasury market isn't just another investment. It's the backbone of global finance. Central banks hold US treasuries as reserves. Investors treat them as the safest asset in the world. If America's credit is questioned, the entire global financial system shakes. During the 2011 downgrade, the Dow Jones Industrial Average plunged over 600 points in a single day. Trillions were wiped from global markets. And that was during a time of lower debt, lower rates, and less global instability. Now in 2025, with debt towering and geopolitical rivalries sharpening, the tremor from another downgrade could become an earthquake. And make no mistake, rivals are watching. China and Russia have long sought to undermine the dollar's dominance. BRICS nations have flirted with alternatives to US debt as a global reserve. Every sign of American dysfunction is a gift to them. Every downgrade, every shutdown, every political crisis is proof to the world that the US is no longer the flawless safe haven it once claimed to be. The longer America stumbles, the stronger the case becomes for an alternative system of global finance.
But let's pull this back down to street level. What does all of this mean for ordinary people? Federal employees missing paychecks, families scraping savings, veterans waiting on benefits, farmers unable to get loan guarantees, seniors seeing delays in Social Security offices. During the 2019 shutdown, more than 800,000 federal workers went without paychecks. TSA agents called in sick. Food inspection programs were disrupted. Housing loans were delayed. Multiply that by today's higher costs of living, and the pain hits even harder. Shutdowns aren't just about Washington politics. They are unpaid rent, empty fridges, foreclosed homes. Here's the bitter truth. Both parties know shutdowns are costly. Both know they damage America's reputation. And yet, time after time, they use them as bargaining chips. It's a game of chicken where the cliff is America's economy, and each side insists the other will blink first. But what if no one blinks? What if the shutdown drags on until markets, not politicians, force a decision? Because markets always punish indecision, and they punish it brutally. So let's confront the nightmare scenarios. Extended shutdown, plus downgrade.
GDP contracts, credit ratings fall, borrowing costs soar, inflation reignites, the stock market tanks, confidence collapse, investors begin demanding higher yields to hold US debt. That spirals into higher deficits as more taxpayer money goes to interest instead of schools, defense, or healthcare. Global shift. Foreign governments diversify away from treasuries. The dollar weakens. America loses leverage in global trade and diplomacy. So, can America afford this shutdown?
The technical answer is yes. America can print money. America can service debt. But the deeper answer, no. No country can afford to repeatedly undermine its own credibility. And credibility is not a resource you can borrow back once it's gone. Think of it this way. Every shutdown is like striking a match in a room full of gasoline. Maybe it burns out quickly, maybe nothing happens, but each time the risk grows. Each time the fumes build, and one day that match could ignite the fire that no one can control. America's shutdown politics aren't just dysfunction. They are a countdown clock, a test of whether the richest, most powerful nation on earth can keep its own house in order. Because if it can't, the world will not wait, and America's collapse won't arrive with a bang. It will arrive one shutdown at a time. The question remains, not can America afford this shutdown, but how many more shutdowns before America can no longer afford itself?